Ujjivan Small Finance Bank's loan growth normalized in the December quarter and expenses seem to have peaked out. Does that mean that the small financier has gotten over the worst of its liquidity crisis, or does the expansion in the ticket size of microfinance loans threaten the lender's asset quality? Let's discuss all of this and more with the MD and CEO, Mr. Samit Ghosh. Mr. Ghosh, good having you. Thanks so much for joining in. Your loan growth numbers seem strong, back to normalized levels that in quarter three at least. I read a note which said that this could last for the next 2 or 3 years. Do you reckon that this can happen, and is this a prediction that you can make reasonably confidently and easily?
So, it's not easy to predict a long-term growth rate, but we expect our asset book to grow around 30 to 35% per annum. And it's largely, we have our portfolio is a microfinance portfolio, and if you see, the industry itself is growing at a much faster clip than that. And then we have also got the micro and small business and housing, affordable housing business. We've just introduced a personal loan business. So those businesses, of course, on the asset side will have a much faster growth rate. At the same time, we have over 460 branches now active, which is primarily raising deposits, etc. So we are, I think, we've built the platform, and we are right now able to grow our business and scale up, which is very essential because we've made all the investments, and we really look forward to the growth in the next few years.
Accompanying this growth, would it be that your cost to income ratios come off because that has peaked out, and maybe your operating expenses too have peaked out? Is that a reasonable assumption?
I think our cost to income ratio has peaked out now, because we had actually deferred a lot of our expansion, branch expansion, etc. To this financial year, because the previous financial year we were coping both with the demonetization problem and transformation to the bank. So we had to slow down the transition to the bank in terms of conversion of our branches to bank branches, etc., just to control the cost. So this year, I think we have bulk of the branches we have converted. We'll have about 40 odd branches which from our microfinance days, which will have to be converted next year, and we probably add another 60 branches. So we'll add another 100 or so branches next year. So as far as the costs are concerned, our investments in people, technology, the physical infrastructure has already peaked out, and now with the scaling of the business, which is essential, we'll be able to bring our cost to income ratio down, which we expect from this quarter onwards.
Okay. So if that happens, I look at brokerage notes and everybody pencils in ROA northwards of 1.6, 1.7, ROE is expanding as well, 15, 17% odd, or maybe more. Would there be a J-curve effect in the return ratios, or a similar drop in the cost to income ratios, a very steep one?
No, I don't think it will be. I think it will be a gradual, the change will be gradual over time, because it all depends on how fast we are able to scale up our business, And being in the lending business, we don't want to scale up too fast. So I think you will see cost to income ratios coming down gradually, and similarly the return on equity, return on asset also improving gradually.
So what are the targets, ROE targets, ROA targets that you would lay out?
So our internal target is obviously around 17-18% over the long run, but it will take us some time to reach that.
Is there a clear and present danger to the rising ticket size, because of the rising ticket size in the MFI portfolio for you as well as the sector? Because a lot of reports speak about that. Higher ticket size, and you don't quite know when the NPL cycle will start coming in, and therefore the risk that it brings along with.
No, I mean in the MFI portfolio, well, I mean some players in the microfinance business have increased their portfolio quite a bit, and that obviously leads to a problem for us from a competitive point of view. But I don't think that is a major issue yet, but what we've seen that often you have very aggressive lenders in certain markets who go and lend sort of indiscriminately, and then they create a issue in those markets, and that kind of danger is there in pockets of different pockets, but just increasing the loan size hasn't created any kind of major danger for us. It's only a competitive issue.
Okay. So you don't think it will be a problem because it's a challenge to predict the timing and the extent of the NPLs? It will not come up to bite you?
So no, the thing is, we are pretty careful. In terms of our loan sizes, and we've seen some players who have increased their loan sizes dramatically. To us, that is a competitive challenge because the customer says that so and so institution is giving us this kind of a size of a loan. Why should we bother with you? But we've not seen that specifically coming into play in terms of the portfolio quality.
Okay, we hope it stays that way. Thanks so much for joining Mr. Ghosh and giving us your thoughts. Really appreciate your time.